market and it just goes completely flat. I mean, dead in the water for months, and then, out of nowhere, it just explodes higher? Well, it turns out that boring sideways price action, it isn't a sign that nothing's happening. It's actually a sign that something huge is happening right under the surface, and it's a secret the big institutions really don't want you to know.
Believe it or not, the pros, the big institutions, they have a saying about these quiet, frustrating times. They say this is where big money is made. Now that's the complete opposite of what most of us think, right? So in this explainer, we're going to pull back the curtain and show you exactly why they say that. But you gotta ask, if this is a gold mine for the big players, why is this same period so incredibly painful for the average trader? It's because they're falling into a trap, a phenomenon many call death by sideways.
I'm sure this sounds familiar. A market just grinds sideways. Any little win you might scrape together gets eaten up by trading fees. You go through this whole cycle, right? You start with hope, then comes disappointment, then you just lose interest, and finally, pure frustration. And that frustration is what makes so many people just give up and sell, usually right before the big move they were waiting for all along.
And this slide just lays it all out side by side. While the retail trader is feeling frustrated and bored, ready to capitulate and sell, the institutional mindset sees something totally different. They see a time for patience and strategy. They don't see inactivity, they see a strategic window to absorb assets. Your capitulation is literally their opportunity.
Let's just be really clear about this. This sideways market isn't an accident. It's a feature, not a bug. It's a trap, and it's specifically designed to shake uninformed traders out of their positions while the so-called smart money quietly loads their bags.
So we have to completely reframe how we think about this. This isn't a dead market. Some of the sharpest analysts call it a silent wealth phase. Think about that. It's a period where these huge institutions are strategically and very quietly buying up every single share from traders who are just too bored or frustrated to hold on anymore.
Now, to really get this, we need to meet the main character in this story, the composite man. Okay, it's not a real person, it's a concept from the legendary analyst Richard Wyckoff. It represents all the big institutional players, the hedge funds, the banks, all acting like a single strategic mind. And their goal? To accumulate a massive position without tipping their hand and driving up the price.
So how exactly does this composite man operate during this silent wealth phase? Well, you'd better believe they have a playbook. It's a set of rules and phases that are, believe it or not, surprisingly predictable once you know what you're looking for.
And that playbook is the Wyckoff method. And no, this isn't some newfangled indicator. This framework was developed over 100 years ago, and it's basically a map for the market's cycles. It proves that all that sideways chop isn't random chaos at all. It's a very structured process of either accumulation or distribution.
All right, let's crack open this playbook. The whole idea here is that a long sideways market, what Wyckoff called the cause, is building up all the potential energy needed for a huge trending move, the effect. And this cause is built in 5 very distinct phases.
Okay, this table basically lays out the entire game plan. You see, it all starts with Phase A, where they stop the previous downtrend. Then you get Phase B. That's the long, grinding part where they build their position. Phase C is where things get tricky. It's a final, deceptive test. And then finally, phases D and E. That's the liftoff, where the new trend begins.
Now I know, that might look a little complicated, but the logic behind it is incredibly powerful. So let's break down exactly how this thing gets built, step by step. Here it is in really simple terms. First, big buyers step in and put a floor under the price. They stop the bleeding. Then comes that long, boring phase where they quietly soak up all the shares for sale. After that, they pull one last scary move to shake everybody out. And then finally, when there are basically no sellers left, the new uptrend can begin. So the part you really need to understand is Phase B. This is the longest and honestly the most psychologically draining part of the whole process. Its job is to build the cause for that next big trend, and it does this by being intentionally long, confusing, and boring enough to completely wear out the patience of everyday traders. And now we get to the most dramatic part of the playbook, the final shakeout. This is the climax of the entire accumulation game. It's the moment of maximum deception, and it happens just before the real move kicks off. So how do they do it? I mean, how does the composite man engineer one last wave of absolute panic to get those last available shares at the best possible price? Well, they use a classic time-tested maneuver. It's called the spring. This is a key event in Phase C. you'll see the price make a sudden, sharp drop below the established support of the trading range. It looks for all the world like the downtrend is starting again. But then, just as quickly, it reverses and snaps right back into the range. It's the ultimate bear trap.
In the spring is just devastatingly effective. Why? Well, for 4 reasons. First, it triggers all the stop-loss orders that people have placed just below that support level. Second, this creates a moment of maximum fear and panic. Third, it lets the institution swoop in and buy up all those panic sells at a huge discount. And finally, and this is key, the quick recovery confirms that the selling pressure is finally totally exhausted.
Okay, so the Wyckoff structure gives us a roadmap. But how can we get even more proof that this institutional buying is really happening? Well, there's one more tool we need, and it involves looking at volume in a whole different way.
Think of it like this. If the Wyckoff method tells us what is happening, then volume profile analysis shows us where it's happening. It's a tool that shows you how much volume was traded at specific price levels, not just over a period of time. This lets us see the exact prices where the composite man has been doing most of their business. And the key thing you're looking for is something called a high volume node, or an HVN. On the chart, it looks like a big horizontal bar sticking out from the side, showing the one price where the most trading activity took place. This is their center of gravity, the fair value zone where they've put most of their capital to work.
And this is what makes it so powerful. Volume analysis lets you, as one source put it, spot the battle lines in the market. You can literally see the price levels that institutions are defending and where control is finally shifting from the sellers to the buyers. All right, so let's bring it all home. What are the key takeaways? Number 1, sideways markets aren't dead. They are active accumulation zones. 2, the composite man is literally using your boredom against you to build their positions. 3, the Wyckoff method gives us the playbook for this whole process. 4, the spring is that critical, deceptive shakeout you have to watch for. And finally, volume profile helps confirm exactly where that smart money has drawn its line in the sand.
So, the next time you find yourself staring at a chart that's going absolutely nowhere, grinding you down with boredom and frustration, I want you to ask yourself this question. Are you seeing a dead market, or are you seeing the silent wealth phase in action? Are you just seeing boredom, or are you seeing opportunity?